think if the Fed doesn't hike next week, that could be the catalyst to get the dollar to resume the bear market or enter a bear market, get gold to break out and into new highs well above 2,000 and continue to move. And I think that is going to start to put a lot of upward pressure on consumer prices.
In today's video, Peter Schiff, founder, CEO and global strategist of Euro-Pacific Capital, gives a warning that the 2008 crisis was just the prelude to a larger sovereign debt crisis in the United States that may lead to a collapse of the US dollar.
First thing I want to discuss is the jobs numbers, the weekly unemployment numbers that came out yesterday on Thursday, because this was a disappointment to the markets in that there was a big spike in weekly jobless claims. The prior week, they were at 223,000 claims, and it jumped up to 261. That's a big jump in a single month. I mean, way above expectations, but a very large jump. And in fact, the number of people filing first-time unemployment claims is now the highest since October of 2021. So in the prior week, the markets were celebrating or heralding this great jobs report when all these jobs were being created, and now we get a very bad weekly unemployment number, a week later. And again, I have been very suspicious, and I've been voicing my suspicion on this podcast of the jobs numbers. We've had, 12 out of the last 13 jobs reports have beat estimates, and these labor numbers or these job numbers, this is what everybody is hanging their hat on to claim that we have a good economy because we have this supposedly strong labor market. Well, the employment numbers have been the only good numbers, and they're only good superficially, but they're the only ones that are. All the other numbers are bad on the surface, and they're even worse when you dig deeper. So the unemployment numbers are the outlier, but they are inconsistent because remember, even though we keep getting these official job reports that are stronger than expected, the household survey, which is released at the same time as the official numbers and doesn't really get much media attention unless the official number is bad and the household numbers are good. See, when that happens, the media finally talks about the household numbers. But when the household numbers are bad and the official numbers are good, well, the household numbers don't even exist, right? Nobody wants to talk about it, especially when, you got Joe Biden in the White House and the media wants to pretend we've got this great economy. So they want to ignore economic data that would cast doubt on that narrative, and they want to just focus in on the data that seems to support, this robust Biden economy. But the fact that you've got this big contradiction between the household numbers and the establishment numbers, that in and of itself casts doubt on the jobs numbers. But then when you see these unemployment numbers, that's also an inconsistency that casts doubt on these numbers. The layoffs that are announced every week cast doubt on these numbers. So there's a big cloud, I think, surrounding all these unemployment numbers. And so I think that you can take them with a grain of salt. And to me, if you're going to look at the unemployment numbers and say we have a good economy because we still have, this strong labor market, then you have to believe that all the other economic data, which is now weak and below estimates, that is going to turn around, that the other data is going to strengthen to be in line with the jobs data. After all, if we have this strong jobs market, we have this strong economy, the rest of the numbers should turn around. I think that's unlikely. I think what's far more likely is that the jobs numbers weaken in line with everything else. In fact, I think it's more likely that we end up getting a lot of revisions in these job numbers that show that they were never this strong the entire time, that the numbers that we were getting were painting a unrealistically positive outlook on the economy or unwarranted strength in the economy based on these job numbers. Maybe it was because of the birth-death model having overestimated how many companies were created on a monthly basis and ignoring the reality that a lot of companies were probably going out of business during that time. So my expectation, again, is that the jobs numbers come back down and we will be in a recession. I think the recession, if it's not already here, and again, you can argue we've been in recession the entire time, but for these phony numbers, but I think before the 2024 election, and probably well before, I think that we're going to have to acknowledge the fact that we are in a recession. But contrary to what investors expect, and that's why the stock market keeps going up. We just finished another week, another up week. The NASDAQ today closed at a new 52-week high, not a record high, but this is a new high. We're in this big bull market now in the U.S. stock market, having risen, more than 20%, quite a bit more in the NASDAQ from the 2022 lows. And what's really driving the increase is the idea that the Fed is done. It's either close to the end or finished with the rate hikes. The only index that was down on the day was the Russell 2000, but even the Russell 2000 had a good week despite giving up some of those gains today. But I think the market's expectation of the rate cuts is misguided. I think they're right. We're going to have a recession and the Fed is going to pivot and the Fed is going to start to cut, but it's not going to cut nearly as deep as the markets expect. So next week, we're going to get the FOMC meeting, and they are going to announce the next move on interest rates. And I think there's a pretty good chance that the Fed is not going to hike rates at all during the June meeting. And I think when they do that, they are going to do it in a way that it doesn't indicate that they're done, that they're kind of taking a break, and that the rate hikes may in fact resume at the following meeting. Because I think they want to kind of take a little bit of the sting out of the fact that they don't want to admit that they're done. They want to soften that. So they don't want to be as dovish as they could, because the markets still expect a hike. So I think if they don't hike, although there's still, a pretty decent probability that they don't, it wouldn't be a complete shock if they didn't hike rates, because I think a lot of people, it may be in the minority, but it's a significant minority, expect that the Fed won't move in June. And so I think they're going to try to act as if they just want to be a little more pensive. They want to be data dependent before the next hike, right? They've hiked a lot, and we don't necessarily need to hike at every meeting anymore. But I think they still want to maintain the bias towards hiking. But I think that if they blink next week and don't hike, I don't think they're going to hike again. They may pretend that they're going to hike again, but I don't think that's their plan. In fact, I think if they don't hike next week, the next move is going to be a cut. Don't know exactly when, but I think it'll be before the election, but there will be a cut. I think this is going to be like that mid-course correction from, I think it was 2019, when the Fed stopped hiking rates back then. And when they did it, they said, well, this is a mid-course correction. They tried to create the impression that they're going to keep hiking. They just needed a small correction from the previous hike before they resumed the hiking cycle, right? They didn't say we're done hiking and now we're cutting. They pretended that the cut meant nothing, that it was just a little mid-course correction, but we're still on course. We're still on the same course of raising rates. We're just correcting that course a little bit with this cut. Well, at the time, I was on my podcast saying, BS, that's it. The Fed's not hiking anymore. It has changed course. It didn't correct the course. It did a 180, and it's going back the other direction, and we're going to get more cuts. And of course, we did. We ended up at zero following COVID. So I think when the Fed tries to indicate this pause, this whatever it's going to be, as for why they didn't move in June. They're going to leave it open that they might go in July with another 25 basis points, or they might go in August. It's kind of data dependent. But again, I think this is the end of it if they pause. What's also going to happen, and one of the reasons that they're pausing, is that the economy is weakening. Forgetting about the jobs data, the economy is weakening. The Fed knows that. And so the Fed doesn't want to continue to kick the economy while it's down, particularly the banking sector. The Fed doesn't want to keep raising rates. I called up Bank of America today. I had a little money over there in this account, and I deposited a check there, and I had the savings account there. And since I put this check in there, I was curious, what's my interest? I hadn't really been paying attention to this account. And they said, well, the interest rate is 0. And I said, well, do you have another account where I can get any interest at all? Is there any savings account that pays any interest above 0? And the agent told me, no, that's it. There's no way to get more than 0. They said they do have an interest checking account that I could get. No, excuse me. It was my checking account that was 0. And I said, are there any checking accounts that pay more than 0? They said, no. They said, if you open up a savings account, though, without checks, then you can get interest. I said, okay, how much? 5 basis points. 5, not even 50, 5, like 1/20th of 1%. That's it. I mean, how is a bank going to survive when it can't pay more than 5 basis points, when the Fed funds rate is 525 basis points? And I talked to this guy at the bank. He said, well, a lot of people have been pulling their money out and moving it over to Merrill Lynch and putting it in a money market account where they can earn about 5%, which of course makes sense. The banks can no longer attract deposits. How do you have banks where you can't have depositors? Because they can't afford to pay the depositors any interest, because they're broke, because the banks have already loaned out all their money for 30 years to the US government or to American citizens. I've got a mortgage with that same bank. Bank of America has my Connecticut mortgage, and I'm paying 3.25%. And there's still more than 25 years left on that mortgage. They are eating it on that mortgage. They're losing a ton of money paying, only collecting 3.25%, right? And I warned about this as I had the mortgage, and as I was talking to people about this, and everybody was so excited about how great it was that everybody could refinance their mortgages. I just kept saying, it's great for the borrower. It's going to be a disaster for the lender. And of course it is. And the Fed doesn't want to put any more pressure on the banks by raising rates even more. It doesn't want to put any more pressure on the commercial real estate market, which has a massive amount of pressure on it already. So the Fed is looking for a reason not to hike. And so, they probably come up with one. But the minute they do this, I think you're going to finally see a drop in the dollar, like the next leg down in the dollar, which is going to spark a move up in commodity prices. The stock market already rose on anticipation of a Fed pivot, but we haven't seen any of that in the gold market. Gold prices, they did spike about $20 on that weaker than expected jobs report, or not jobs report, unemployment number that came out on Thursday. But we're still just treading sideways. We're holding below 20,000, 1,960. But we haven't seen an explosive move up. We haven't seen a big breakout in other commodities, oil, nothing. It's just been the stock market that has basically been the big mover, moving on anticipation of the change in monetary policy, moving from a tightening cycle to an easing cycle. But I think if the Fed doesn't hike next week, that could be the catalyst to get the dollar to resume the bear market or enter a bear market, get gold to break out and into new highs well above 2,000 and continue to move. And I think that is going to start to put a lot of upward pressure on consumer prices. I've been saying I think we're near the trough in year-over-year CPI, and I think we are. The last couple of CPI numbers have been worse than expected, meaning higher increases, month over month, year over year. So we've kind of bottomed out at around this 5%. I mean, miles away, not even close to 2%. And then we're going to start heading up. And here's going to be the problem for the Fed. As inflation starts to pick up, after they've already paused, and as the economy is weakening, and especially if they've started to cut, right? So, because they may start to cut rates before the inflation numbers really start to get bad. But if they're not really bad before that first rate cut, they're going to get bad after it. And I think all this is probably going to happen, before the 2024 election.